What I am saying is that when silver does break out, it's truly an amazing financial circumstance for those speculators who can afford it, and those speculators who have the emotional stability to handle the volatility that you're going to see.
You're watching Silver News Daily. Subscribe for more.
Did you know that silver could be on the verge of smashing through its all-time high, and it might happen sooner than you think? Rick Rule, a legendary investor in the precious metal space, believes the stage is set for a historic breakout, with silver poised to burst past the critical $32.50 resistance level. We could be looking at a surge to $50 and beyond. But what's driving this explosive potential? Stay tuned as we break down the key factors and reveal why now might be the most critical time to get ahead of this massive opportunity.
About what we might call the retirement or endowment business worldwide. But I'm not saying that. Money managers, among other things, are mostly, at least, human. And they're given to many human frailties. One of which is that many of us as money managers can sleep like the last war. We've been through a period, 1982 to 2022, by my reckoning, 40 years of tame inflation, a strong U.S. dollar, a strong bond market, strong equities markets, great demographics, where investors had the winds in their sails. And I think that really changed in 2022. I think an accumulation of bad habits over 40 good years, in particular, the tolerance for systemic deficits, the incredible amount of recourse and off-balance sheet liability encumbering the U.S. government, means that the landscape in front of us is different than the landscape behind us. But I think it's fair to say that many of the people who manage pensions, endowments, profit-sharing plans, things like that, are managing for the last 40 years rather than for the next 10 years. Imagine, as an example, owning the very long bond, which is a staple for long-term investors, the 30-year bond. If the interest rate goes up, the capitalized value of your distributions, which is to say the principal, goes down. But if the interest rate doesn't go up and inflation stays high, the distributions, the spending power that you get in terms of the distributions for the 30-year bond goes down too. Heads you lose, tails you lose. In an asset class that's one of the most important asset classes in terms of the constituents of those very long-term portfolios that you're talking about. There has also, I think, been a rewarded preference for large-cap U.S. growth stocks. When one looks at the length and breadth of the U.S. equities market, what one is struck with is the fact that much of the growth that we're seeing in the equities markets is confined to 20 or 30 stocks. When somebody's buying an S&P 500 index fund, what they're really buying is a large cap growth fund. And people need to understand that. I'm not saying it's a bad thing. What I'm trying to say is it comprises too large a portfolio for most pension and profit sharing plans. And I also think that the lack of breadth in the equities market is also concerning. I need to say I'm less concerned, frankly, about equity bets in the broader U.S. market than I am the long bond. The long bond seems to me to be an almost guaranteed loss. I'm concerned, too.
In the past year, silver has lagged behind gold's impressive rally, leaving many investors frustrated and skeptical. While gold soared to new heights, reaching record levels near $2,685 per ounce, silver struggled to break through its key resistance of $32.50. But here's the critical point. This is not a sign of weakness. Rather, it's the setup for something much bigger. Let's break this down. Historically, silver often lags in bull markets quietly building up momentum before it finally surges past gold. This pattern is not new. We've seen it during previous market cycles where silver started slow, only to explode once the right conditions aligned. In fact, silver has already jumped by nearly 50% this year alone, indicating that the metal is gaining momentum. Analysts from the London Bullion Market Association predict that silver could gain as much as 40% in the next 12 months, pushing it to $45 an ounce. But this rally isn't just about numbers. It's about timing and overcoming critical thresholds. Silver's spot price has attempted to break the $32.50 mark twice this year, in late September and early October, but fell short each time. So why is this resistance level so important? The $32.50 barrier, established at the May high, has become the tipping point. If silver can decisively break above this mark with strong trading volume, it could signal the start of a massive rally. And that's where the excitement begins. Once this level is cleared, experts like Rick Rule believe that silver could surge rapidly, heading straight for the $50 mark. We're at the tipping point, and the market setup indicates that this could be the time when silver finally takes off. So the big question is, are you ready for what's coming next?
I hope to move on to cheerier topics later. I'm concerned, too, with my banker's hat on, about the concentration in the banking industry and, in fact, in the pension and profit-sharing industry generally around commercial real estate mortgages. I don't think that shoe has dropped yet. I see buildings changing hands for 20 or 25% of previous highs. And I wonder what happens to a mortgage holder in that circumstance with 65% loan to value. Well, I don't wonder. I know, in fact, what happens. And I'm afraid that if we see another tick up in interest rates, that question is going to be called on a massive scale. But then again, the thing that scares me the most, as if those weren't bad. And by the way, I'm not telling people to curl up in the corner and quit. I'm just telling people that they need to be concerned themselves about their retirement, as opposed to handing off responsibility for it to the so-called pros. The thing that scares me the most in the current landscape are the so-called high yield or junk debt ETFs. It's been a very long time since we had a credit squeeze or a liquidity squeeze. And people who are savers have been, in effect, forced by very low interest rates to take more yield risk and more credit risk on their savings. And the consequence of that is that there are trillions of dollars invested in high-yield ETFs, junk bond ETFs. And what scares me about that is that while the top vehicle, the ETF itself, is extremely liquid, trading billions of dollars a day, the constituent assets of the ETF, over-the-counter, non-investment grade bonds, are very illiquid. And if we have a circumstance where the average ma and pa in the country who doesn't know very much about credit analysis, but wants 2% or 2.5% higher yield, if those people become concerned about credit quality and begin to sell those ETFs, the managers will have a very rough time selling enough of the underlying credits that they can manage redemptions. I've used this quip on your show before, but I remember the last junk bond fail that we had in the 1990s. And we had a saying about illiquid high yield over-the-counter bonds. We used to call them owl bonds. An owl bond is a bond where you call your broker and ask your broker to sell, and they say, to whom? To whom? And that really scares me. The idea that we could have, in effect, a run on the bank where the bank are these high-yield ETFs and there's nobody behind the bank really scares me. It really, really, really does scare me. The impact of that goes beyond university endowments all the way to private savings, because many people who are managing their own 401ks have sacrificed credit quality for current yield. I hope it works for them, But I just need to say, my own background as a credit analyst, and I have not in my own portfolio sacrificed credit quality for yield.
To truly understand the potential of silver's upcoming breakout, we need to look back at Rick Rule's extensive experience and track record in the precious metals market. Known for his contrarian investing philosophy, Rule has consistently urged investors to remain patient during periods of stagnation, and history shows that his predictions often come to fruition. In the past, Rule's insights into silver and gold markets have proven remarkably accurate. He emphasizes that silver's performance often mirrors that of gold, but with a delayed reaction. For instance, in the early 2000s, gold had already begun its upward trajectory when silver was still trading at historically low prices. Yet when silver finally caught up, it outperformed gold by a substantial margin, delivering massive gains for those who timed their entry well. This is a pattern that has repeated itself multiple times over the decades, and Rule has been there each time to capitalize on these market moves. But what makes Rule's approach particularly powerful is his ability to identify the precise moments when silver transitions from stagnation to explosive growth. He looks beyond short-term price action and focuses on macroeconomic factors, technical indicators, and historical cycles. In his recent commentary, Rule pointed out that silver's long-term chart shows a breakout from a 2-decade-long triangle pattern, a formation that signals a powerful bull market ahead. He notes that this kind of technical setup is rare and often precedes significant price movements. Rule's deep understanding of market cycles and his ability to pinpoint key resistance levels make his current prediction, silver reaching $50, a compelling call to action for investors. He believes that the conditions are lining up in a way that's reminiscent of past silver bull markets, suggesting that we are on the brink of another historic rally. For those who have followed Rule's advice in the past, the message is clear. The time to act is when sentiment is low and prices are still consolidating. As Rule often says, be a contrarian or a victim. The opportunity to buy silver before it breaks out of its long-standing resistance could be one of those rare chances that savvy investors have been waiting for.
Let's think about defined benefit. Let's think about the fact that rather than having a defined contribution plan, you have a defined benefit plan. It doesn't say anything about what the purchasing power of the defined benefit that you receive 10 years from now is. And that could be a very ugly surprise. I came of age in finance and investing in the decade of the 1970s. And I remember that in the 1970s, the U.S. dollar in 10 years lost approximately 75% of its purchasing power. If you came into that decade with sort of $500 a month in disposable income, you felt okay. If you came out of that decade with $500 a month in disposable income, you got slender, and involuntarily slender. And so when people talk about their reliance on a defined benefit plan, I think what they're doing is they're talking about lessons that they learned in a very benign period, 1982 to 2022. And I think that period's behind us. And I think that the question that you asked me is probably the most propitious question that people can ask in finance today. We've also talked about this before, but the idea that we're going to get through the next 10 years without substantially debasing the U.S. dollar is, I think, arithmetically challenged. We have $35 trillion in recourse on-balance sheet liabilities to the federal government. We have, by the government's own count, the Congressional Budget Office, over $100 trillion in the net present, not nominal, net present value of off-balance sheet liabilities, things like Medicare, Medicaid, Social Security, federal government pensions, military pensions. Now, we try to service this debt with a budget that's in deficit $2 trillion a year. In other words, rather than filling the hole, we're making the hole deeper. And some estimates suggest that the accretion of the deficit in the net present value of entitlements is increasing by $4 trillion a year. Just for the record, that's more than federal revenues. We faced this before, but to a less egregious extent in the 1970s. And we solved the problem by inflating away the net present value of the obligation. Inflation means that nominal taxes go up because they're not indexed to inflation at the same time that the spending power of the deficit, of the benefit falls. And when people take into account the totality of the question that you've asked, they need to think about the probability that we don't experience the degradation in the purchasing power of the U.S. dollar.
Now, let's dive into the technical side of silver's current setup, focusing on the critical $32.50 resistance level. This barrier isn't just an arbitrary number. It represents a significant psychological and technical threshold in the silver market. To put it simply, breaking through this level with strong volume could be the signal that unleashes a powerful bull run. First, let's understand why $32.50 is so important. This level was established back in May and has since been tested multiple times, most recently in September and October of this year. Each time, silver has approached this point, but a lack of sustained momentum in trading volume caused it to retreat. These failed attempts highlight the importance of not just touching, but decisively closing above this price with strong support from market participants. But why is volume so critical in this scenario? Trading volume acts as a measure of market conviction. When silver attempts to break a key resistance level, if the move is accompanied by heavy trading volume, it indicates widespread participation and confidence from both institutional and retail investors. This kind of volume-backed breakout often transforms resistance into new support, setting the stage for further price advances. The technical analysis also shows that a close above $32.50, combined with a surge in trading volume, could pave the way for silver to rapidly target $50. Experts like Rick Rule stress that this breakout is not just about price. It's about confirming market strength and eliminating the risk of a false breakout. Additionally, Rule points to the importance of watching silver's performance in other currencies, such as the euro. If silver breaks key levels in multiple currencies simultaneously, it strengthens the case for a global rally, reducing the risk of dollar fluctuations distorting the signal. The stakes are high and technical traders know this. Many momentum-focused funds are poised to enter once a breakout is confirmed. This means that the move above $32.50 could potentially trigger a flood of new capital into the market, driving prices even higher. So what does this all mean for investors? The $32.50 level is a make or break point. If silver clears it with conviction, we could witness a rapid acceleration in price action, making $50 not just a target, but a realistic short-term milestone. The technical setup is there. Now it's all about timing and volume. Are you prepared for what could be the most significant silver rally in years?
They're becoming aware of it. When I have discussions on shows like yours that are open mic, and I express concern about inflation, many people say to me, well, inflation's only 2.6. It's only reflected in the CPI. If people would do a thought experiment, and they would attempt to tabulate the basket of goods and services that they buy for their family, not the one that the big thinkers think they buy, but rather things like food, gasoline, healthcare, shelter, things like rent. What I think they'll learn is that the purchasing power or rather the basket of goods and services that they consume, means that the purchasing power of their savings is deteriorating at closer to 7% compounded than it is 2.6%. That becomes a real problem if, as an example, you're invested in the 10-year Treasury yielding 4 in a currency that's depreciating at 7.5% a year. What it means is that you're losing 2.5% of your purchasing power compounded every year. Can you do that for a year or two? Sure. Yeah, absolutely. You need to have some liquidity. But over time, that takes its toll. It takes an ugly toll on your lifestyle 10 years out and 15 years out. That's why I was saying that people need to concern themselves with it. They don't need to panic. This isn't something where you just throw up your hands in defeat and go hide in the corner and cry. But when you are making investment decisions and you are thinking about appropriate levels of savings and you're allocating assets in your own portfolio, you should not be sanguine about the performance of your pension, your profit-sharing plan, any endowment that you might be involved in. Those are going to be very, very challenging for the next 10.
Over the past year, the world has faced heightened geopolitical tensions, economic uncertainties, and a shift in global monetary policies. These factors, combined with inflation concerns and a weakening U.S. dollar, have created a perfect storm that's pushing investors towards safe haven assets like silver. One of the most significant drivers behind silver's recent momentum is the trend of de-dollarization. Across the globe, countries are becoming increasingly wary of relying solely on the U.S. dollar for international trade and reserves. Central banks, particularly in emerging markets, are diversifying their holdings by accumulating precious metals, including silver, to protect themselves against the risk of dollar depreciation and currency manipulation. This trend has been accelerating as more central banks and countries move away from dollar-denominated assets. The demand for silver and gold as alternative stores of value continues to rise. Additionally, uncertainties surrounding the upcoming U.S. presidential election are creating even more instability in markets. Investors are bracing for potential shifts in fiscal policies, which could have major implications for the dollar's strength. With the fear of economic instability increasing, many investors are turning to silver as a hedge against potential devaluation and market volatility. Another crucial factor supporting silver's bullish outlook is the ongoing global race to cut interest rates. Not only has the U.S. Federal Reserve signaled rate cuts to combat slowing economic growth, but other major central banks have followed suit. Rate cuts reduce the opportunity cost of holding non-yielding assets like silver, making it an attractive option for investors seeking to preserve value. With inflation starting to moderate in some regions but still looming as a threat in others, the environment for silver remains highly favorable. The combination of geopolitical risks, currency concerns, and accommodative central bank policies creates a robust foundation for silver's future growth. This isn't just speculation. This is a reaction to real, observable economic trends. When we tie these macroeconomic shifts together, it becomes evident why experts like Rick Rule are so bullish on silver's near-term potential. So, how do these factors impact your strategy as an investor? The signals are clear. Silver's appeal as a safe haven and inflation hedge is growing stronger by the day. The global economic landscape is setting the stage for a silver rally that could take prices to levels we haven't seen in decades. Are you positioning yourself to benefit from these monumental shifts?
Well, let's look at it historically. Pick a starting date. If you started when I started investing, which is 1970, the gold price is up from $35 to $2,600. That's less good than you think when you take into account the deterioration of the purchasing power of the dollar. But what gold did over those 50 some odd years is it protected the purchasing power of those who owned it. Fast forward to year 2000. Gold is at what, $252, $255 an ounce? In the ensuing 24 years, although gold didn't spike, and although many people are disappointed inexplicably in gold's performance, it did generate almost an 8% compound internal rate of return. That corresponds very nicely, I think, with the current rate of deterioration of the U.S. dollar, which is to say, you don't necessarily buy gold to make money, although when it moves, it really, really moves. What you buy it for is to reduce the deterioration of the purchasing power of your savings. How much gold you own depends on how much insurance you need. if you own a small business and the good or service that you provide is necessary enough to your customers that you have some pricing power, which is to say, if you can pass on the cost increases that you incur in the price of your product, if you're inflation hedged internally, you need to own less gold. Similarly, if you run an intelligently managed, rationally leveraged real estate portfolio, where inflation increases your rents while at the same time they increase the cost of people building product to compete with you, you have a built-in inflation hedge, provided, of course, that this is intelligent real estate, intelligently leveraged as opposed to crazily leveraged, and you need to own less gold. But if you're a recently retired physician, you've had a great 40-year run, you have a $5 million retirement, you are spending $350,000 or $400,000 a year to sustain your current lifestyle, and your retirement is mostly in long bonds, I think you're going to have an interesting experience this decade. And I think you need to own enough gold that you can hedge against the deterioration of the purchasing power of the distributions that you'll get from your long bonds.
One of the most powerful drivers in the precious metals market is the activity of central banks. Over the past few years, central banks around the world have significantly ramped up their purchases of precious metals, especially gold. But what's even more intriguing is their growing interest in silver, a shift that could be a major catalyst for a breakout in silver prices. Historically, central banks have used gold as a reserve asset to stabilize their currencies and hedge against economic turmoil. However, with recent geopolitical tensions and economic uncertainties, we're seeing a broadening of this strategy. Countries like China, Russia, and India have not only increased their gold reserves, but are also accumulating silver. This move suggests a diversification effort away from the U.S. dollar, reflecting concerns over dollar stability in international financial systems dominated by U.S. influence. The central bank's pivot towards silver is a critical signal for investors. When major financial institutions begin diversifying into silver, it demonstrates their long-term confidence in metals value. This trend is particularly evident in countries that seek to reduce their reliance on the dollar due to geopolitical or economic conflicts with the United States. For instance, after the U.S. froze Russian assets following geopolitical disputes, other nations took note, prompting them to seek alternatives to dollar-denominated assets. Silver, with its dual role as an industrial and monetary asset, fits perfectly into this diversification strategy. This shift is not just speculative. It is backed by data. The World Silver Survey reported that central banks' silver holdings have quietly increased over the past few years, mirroring their moves in the gold market. Such accumulation by large, influential entities can have a massive impact on price dynamics, especially in a market as volatile and sentiment-driven as silver. What does this mean for individual investors? When central banks start buying silver, they create a significant upward pressure on demand, which in turn supports higher prices. This behavior sends a powerful signal to other institutional and retail investors that silver is not just an industrial commodity, but a strategic reserve asset. This shift in perception could catalyze a major revaluation of silver in the eyes of the market. The message is clear. Central banks are preparing for a changing economic landscape, and silver is becoming a crucial part of their strategy. As they continue to increase their holdings, the supply available for private investors shrinks, creating a supply squeeze that could further boost prices. Are you ready to follow the smart money and capitalize on this central bank movement before it's too late?
I don't distrust our government more than I trust other governments. I'm convinced that the most dangerous government is the one closest to you. For me, that happens to be the U.S. government. But it does mean that the global hegemony that the United States dollar has enjoyed as a medium of exchange is slowly being chipped away. It's not going to go away overnight, But countries, particularly countries that have active disputes with the United States, and there's a lot of those, have come to understand that they can't allow the U.S. government to control their trade. The only instrument that they have that they can trade with each other in, because they hate each other's currencies more than they hate ours, is gold. That's a fairly simple circumstance. The other circumstance also relates to the U.S. dollar, which is to say that the U.S. Treasury, which is largely what's being displaced by gold in these foreign central banks, is a lousy deal. Again, let's look at the arithmetic around the U.S. 10-year. They're paying you 4%, where the purchasing power of the distribution is declining by 7.5%. The U.S. government solemnly swears that they will destroy your purchasing power by 2.5% a year, compounded. If you were China and you thought about this guarantee, this is, formerly the best credit in the world is absolutely positively guaranteeing me that my purchasing power will decline by about 30% over 10 years if I invest in their treasury. It's no wonder that there is disintermediation from U.S. Treasury securities to gold among central banks around them. And I think it continues for those reasons, because I don't think that the United States, irrespective of what party gets into power, will have any interest in reducing American hegemony. In other words, I don't think that either Trump or Harris would be content running the United States. I think both of them want to run the world. And the rest of the world has some objection to that, which I think is fairly understandable. The second thing is that I don't think either Trump or Harris will do anything to restrain the U.S. deficit. I mean, Trump makes some promises about the fact he's going to bring in Elon Musk and fire 80% of the federal workers. All anybody needs to do who believes that claptrap is read the book The Triumph of Politics by David Stockman, who was the director of the Office of Management and Budget in the first Reagan administration. And you'll understand what a bald-faced lie that is. So when you have no reduction in U.S. hegemony, which means you have no reduction in the disintermediation out of U.S. Treasury securities for gold for geopolitical reasons, and you have no reason to suspect that the deterioration of the purchasing power of the U.S. dollar will be constrained, the outlook to me is pretty clear.
While silver's role as a monetary asset is crucial, its industrial applications are equally, if not more, influential in driving demand. Silver's unique properties, being the best conductor of electricity and heat among all metals, make it indispensable in several high-growth industries. And this industrial demand is another critical factor propelling silver's price upward. Let's start with the electric vehicle HEV revolution. As governments worldwide push for greener energy solutions, electric vehicles are gaining momentum, and silver plays a vital role in this transformation. EVs use almost twice as much silver as traditional internal combustion engines. From wiring systems to battery technology, the need for silver in EV manufacturing is substantial. As automakers ramp up production to meet ambitious climate goals and consumer demand, the strain on silver supply will likely intensify. Beyond vehicles, the renewable energy sector, particularly solar power, is another massive driver of silver demand. Silver's superior conductive properties make it an essential component in photovoltaic cells used in solar panels. With global initiatives pushing for a shift to renewable energy, the solar industry is booming. According to the Silver Institute, industrial demand for silver in solar panel production hit a new all-time high in 2023, and this trend is expected to continue. As more countries invest in solar farms to transition away from fossil fuels, silver's role in supporting this infrastructure becomes even more critical. But it doesn't end there. The rollout of 5G technology and the continued growth of mobile devices also heavily rely on silver. 5G infrastructure requires significant amounts of silver for its base stations and antennas. Similarly, the demand for tablets, smartphones, and other electronic devices, each requiring small but cumulatively massive amounts of silver, continues to grow. These sectors are driving up silver's industrial use, creating a tight supply-demand dynamic. The combination of these trends paints a clear picture. Silver's industrial demand is not just a short-term phenomenon. It's a structural shift that will persist for years. As these high-tech sectors expand, the pressure on silver supply will increase, making it a highly attractive asset for investors who recognize its potential. The implications are huge. As industrial applications continue to consume more silver, there's less available for investment purposes. This creates a situation where silver's dual identity, as both an industrial metal and a precious asset, pushes its value even higher. For those watching the silver market, this industrial demand surge is a key factor that could drive prices to unprecedented levels. So, are you positioning yourself to benefit from the silver boom, driven by these cutting-edge industries? Because the green and digital revolutions aren't slowing down, and silver is right at their core.
The increasing central bank purchases of silver, which you've correctly documented, surprised me. It isn't something that I've seen before. And I've been struggling. Well, I haven't been struggling. I've been asking people who are smarter than me what it means. And I haven't received a satisfactory answer. Part of it would suggest that foreign central banks are becoming semi-speculative, that they have looked at history and seen that silver has outperformed gold after gold has established a trend. And if they think gold has established a trend, perhaps rather than just defending their economies with gold, they're going to try to make a profit. Historically, the concept of central banks making a profit is a concept that has never occurred before. So I'll leave the efficacy of those strategies to other people. The other theory that I heard is that India in particular, but perhaps India and China too, as a consequence of historic cultural attractiveness to silver, are going to encourage retail savings in their own countries in silver. Part of me has a trouble believing that, because I think that in India, for sure, silver would crowd out the rupee. In other words, people would go for real money as opposed to government money. Too sweet. And I think that the government might be smart enough to understand that. China might be trying to do the right thing. I don't know. But what you suggest, which is to say that we are seeing increasing central bank purchases of silver, is a phenomenon that I've never seen before. And I can only speculate as to its cause. I also, if your listeners will replay earlier interviews that you and I did, suggested that the leadership in precious metals markets needs to be established before gold follows suit. If you start seeing momentum in silver, however, silver bull markets are very, very, very emotional. I'm not saying that Russian central bank buying, Chinese central bank buying, Indian central bank buying will give silver the momentum that it needs to break out. But what I am saying is that when silver does break out, it's truly an amazing financial circumstance for those speculators who can afford it, and those speculators who have the emotional stability to handle the volatility that you're going to see in the silver market. An allocation to the higher quality silver stocks and the silver juniors, a small allocation to be sure, an allocation that you can afford to lose 30% of if you're wrong, and an allocation that you can stomach 15% volatility and for no reason other than it's Monday or Tuesday, is something you should consider.
While the technical and industrial aspects of silver are compelling, one of the most powerful forces that could drive silver prices higher is the market sentiment itself, specifically the fear of missing out or FOMO. As silver approaches and tests key resistance levels, the market's psychology comes into play, creating an environment where FOMO could amplify price movements significantly. In the precious metals market, FOMO isn't just a buzzword. It's a real and influential phenomenon. When traders and investors see silver testing critical levels like $32.50, it generates excitement and speculation. Hedge funds, retail investors, and even momentum-driven trading algorithms start piling in, not wanting to be left behind if silver breaks out. This influx of capital can quickly drive prices higher, creating a self-reinforcing cycle where the fear of missing out fuels even more buying pressure. We're already seeing early signs of this behavior. Over the past few months, hedge fund activity in the silver market has been volatile, with funds reducing their net long positions during dips, but then quickly re-entering as prices rebound. This cyclical buying and selling suggests that funds are actively monitoring silver's price action, waiting for a definitive breakout to commit more capital. If silver closes about its $32.50 resistance level with strong volume, these funds could flood into the market, propelling prices rapidly. Retail investors are also playing a significant role. Historically, retail traders have been quick to jump on precious metals rallies, and silver's accessible price point makes it an attractive option for smaller investors who might find gold too expensive. Platforms like Reddit's Wall Street Bets have already shown their influence in driving silver prices higher in early 2021, and this community's interest remains strong. With social media and online trading communities more influential than ever, a wave of retail buying could easily push silver prices beyond expectations. This fear of missing out isn't limited to small investors or hedge funds. Large institutional players are also increasingly cautious about missing the opportunity to profit from a silver rally. As they see more funds and retail traders entering the market, they may begin to adjust their own positions to capitalize on the momentum. This layered effect, where retail, hedge funds, and institutions all chase the same opportunity, can create a powerful surge in silver prices. The bottom line: market sentiment and the fear of missing out are real and influential forces. When combined with silver's technical setup and fundamental drivers, they could be the final catalysts needed to push prices beyond their long-standing resistance levels. As silver starts to rally, the urgency among investors to not miss out will only grow stronger, potentially transforming a moderate breakout into a massive price surge. So the question is, will you be ahead of the crowd or chasing the wave once the FOMO frenzy begins?
Up very quickly, albeit from an infinitesimal base. Well, I've talked in your show before about the fact that precious metals and precious metals-related securities comprise less than 0.5% of savings and investment products in the United States. I've used a colorful analogy that they're as important to the economy as a pimple is to an elephant's behind. They kind of don't matter. But it's worthy to note that over the last 4 decades, that market share has been 2%. So if demand for gold and silver merely reverts to the 4-decade mean, which is what I think it will do, that implies a 4-fold increase in demand. And that would do a very, very interesting thing to price. Away from arithmetic and into narrative, I note that inbound inquiries, which is to say subscribers to Rule Investment Media, are currently running about 50 per day. The majority of those, interestingly, are non-U.S. now. And they are coming from everywhere. A couple of interesting trends. One, and stands to reason, a lot of German interest, because the German government has been even dumber than the American government. And there's a whole generation of young Germans who understand that they were fed a bunch of horsepucky by Merkel and her ilk, and have, I think, come to the rightful conclusion that they need to own precious metals. The other thing that's interesting, Donegan, which I've never seen in a market before, is that
To fully grasp silver's potential, it's essential to compare it with gold, its long-standing counterpart in the precious metals market. Historically, silver has often been referred to as poor man's gold, but in reality, its price movements are anything but modest when it catches up to gold. In fact, silver has the potential to outperform gold significantly once it starts moving, making it a prime opportunity for those looking to capitalize on this upcoming rally. Let's look at the gold to silver ratio, a critical metric used to determine the relative value of these two metals. This ratio essentially tells us how many ounces of silver it takes to buy 1 ounce of gold. For decades, the historical average of this ratio has hovered around 50:1. However, even with gold reaching record highs, silver has remained undervalued, and the ratio has climbed above 80:1, indicating a substantial imbalance. This discrepancy suggests that silver is currently trading well below its intrinsic value when compared to gold, providing a significant upside potential. If the gold to silver ratio were to return to its historical average, even without any additional increase in gold prices, silver would need to rise to approximately $1.50 per ounce. This reversion alone represents a massive gain for silver investors. But if gold continues its upward momentum, potentially pushing towards $3,000 per ounce, some analysts predict silver's price could go far beyond the $1.50 target, delivering exponential returns for those positioned early. Another way to understand silver's potential is to adjust its price for inflation. During the 1980 peak, when the Hunt brothers famously cornered the silver market, silver reached an inflation-adjusted price of around $143 per ounce. Even during the 2011 bull market, driven by massive quantitative easing, silver hit $68 per ounce in inflation-adjusted terms. Today, silver trades at just over $31, indicating there is substantial room for growth if it's to reach these historical levels once again. Silver's delayed reaction to gold's movement is a familiar pattern. In past bull markets, gold typically sets the trend, attracting early investors and building momentum. Silver follows later, but with much greater speed and intensity, often outperforming gold during these rallies. This is due to silver's smaller market size and higher volatility, making it more sensitive to the shifts in market sentiment and capital inflows that gold initially attracts. Rick Rule himself points out that savvy investors can capitalize on this phenomenon by buying silver when it is undervalued compared to gold. His approach focuses on the gold to silver ratio as a key indicator of when to enter the market. As he sees it, silver's current undervaluation is a rare opportunity for investors to take advantage of the metal's explosive potential once it begins to correct and align with gold's trajectory. So how does this comparison influence your strategy? The answer is simple. While gold may continue its climb, the real opportunity for outsized gains lies in silver. When silver finally catches up to gold, it doesn't just follow, it often leads. Are you prepared to ride this wave as silver aims to outshine gold once again?
A third of my increase, a little less, 30% of my increase, are now coming from young women. It used to be that the gold audience looked like me. Old, fat, bald, white, rich. And there is an increasing interest among young women in gold, which, by the way, anecdotally was supported by Costco, which, as you know, is now, at least nominally, in the bullion business. And they have reported that a surprising number of the buyers of gold have been younger, and a surprising number have been female. So I think that's some anecdotal evidence, not statistical evidence, but rather anecdotal evidence, which would suggest that the market for gold and the awareness of precious metals among retail investors generally is swinging up. It's important to note, too, that as dangerous as U.S. dollar participation is, that old Casey joke about the U.S. dollar being the worst currency in the world except all of the others applies when we talk about gold breaking out into nominal highs against the U.S. dollar. In other currencies, gold has performed spectacularly well over the last 5 years. And so I think if you're a saver in almost any currency in the world, other than the US dollar, gold has already established momentum. It's already established a trajectory. And if I had to guess why an American database like Rural Investment Media is becoming increasingly non-US, I suggest that the price action in precious metals in those securities has already demonstrated thesis, while in the United States, the thesis is still being questioned.
Now, we arrive at the crux of Rick Rule's bold prediction. If silver breaks past the critical $32.50 resistance level with strong volume, it could set off a massive rally, one that pushes the metal all the way to $50 and beyond. This isn't just speculation. It's a prediction based on decades of market behavior, historical analysis, and current macroeconomic conditions aligning perfectly. Rule's projection hinges on several key factors that we've outlined: the technical barriers that silver is poised to overcome, the global economic environment driving demand, central bank accumulation, and the explosive potential from industrial uses like electric vehicles and solar panels. All these elements build a compelling case for silver's upcoming breakout. But it's not just about reaching $50, that's only the beginning. When silver rallies, it tends to move rapidly, catching many by surprise. The market's smaller size and high volatility mean that when momentum builds, silver can quickly surpass targets that once seemed ambitious. In the 1980 and 2011 rallies, silver surged far beyond initial expectations, propelled by a combination of technical breakouts and a wave of investor enthusiasm. This time, with the current setup, it could easily repeat this behavior. Experts like Rule stress that the psychological impact of hitting a significant milestone like $50 cannot be underestimated. If silver crosses this point, it could trigger another wave of buying as investors rush in, fearing they'll miss the next leg up. The $50 mark is not just a technical or historical target. It's a psychological threshold that, when breached, often opens the floodgates for additional capital inflow, magnifying price gains. But why stop at $50? Rule suggests that if inflation remains persistent and central banks continue to cut rates or weaken their currencies, silver could go much higher. The last time silver reached such levels, it was reacting to massive economic shifts, currency debasement, and investor panic, all conditions that seem eerily similar today. As such, the upside potential for silver could far exceed the $50 mark, reaching new highs and providing an unparalleled opportunity for those positioned early. The implications are clear. Silver is not just a play for small gains. With the perfect storm of technical momentum, industrial demand, central bank activity, and global economic conditions, silver is on track for an explosive move. The time to act is now, before silver clears these critical levels and becomes a crowded trade. So the final question remains: will you seize this opportunity and position yourself ahead of what could be the most significant silver rally in decades? Or will you watch from the sidelines as the price rockets past $50 and beyond?
Our boot camps, first of all, are very deep dives into one topic. We don't cover the waterfront. So silver was all about silver, uranium all about uranium, royalty and streaming all about royalty and streaming. Tier 1 deposits are those very large, multi-decade deposits that make companies. My definition of a Tier 1 deposit is a deposit with at least $10 billion in recoverable reserves and resources that could or will generate over $1 billion a year in revenue, that will be in the bottom cost quartile in its commodity, and will be in the best quartile, but at least 25% in return on capital employed. These are company makers. If you are lucky enough to discover one in a small company, there's almost a virtual guarantee that the company will be taken over. If you are fortunate enough to be able to invest in large companies that have Tier 1 multi-decade deposits, what you see is that the stability and the quantum of the return on capital employed over time increases. It is a truism that large deposits always yield surprises, and those surprises are almost always good. It is also a truism that if your deposit can last 2 or 3 decades, that deposit will give you 1 or more bull markets in the course of its life. One of the things that's been very good to me in my life, Dunnigan, has been being able to identify discoveries that could become tier 1 deposits and owning them, to be sure, while they were still speculative, before they were proven. But owning a $50 million market cap that becomes, after the preliminary economic assessment, a $250 million market cap, that becomes, after the pre-feasibility study, a $750 million market cap, that becomes, after the commencement of production, $1.5 billion market cap, and gets taken over for $3 billion. People need to understand that big deposits and small deposits.
We've walked through the critical factors: technical levels, economic drivers, central bank activity, and surging industrial demand that makes silver's breakout not just possible, but likely imminent. All these elements build to one conclusion: silver is on the cusp of a historic price surge, and the opportunity to capitalize on it is closing fast. Rick Rule's insight into the market cycles of precious metals shows us that when silver catches up to gold, it does so with speed and intensity, often outpacing its counterpart. With silver hovering just below its $32.50 resistance level, it's poised to make a decisive move. Once this barrier is breached, the momentum could easily carry prices to $50 and beyond, especially with central banks and retail investors piling into the market, driven by a fear of missing out. The fundamentals support this rally: global economic uncertainty, currency debasement, and industrial demand from EV solar energy and 5G technology are all pushing silver into a favorable position. When combined with silver's historically undervalued status compared to gold, these forces create a perfect storm. The set was there, and all signs point to silver breaking through, not just hitting $50, but potentially surpassing its previous all-time highs. But remember, while the opportunity is immense, so are the risks. As with any investment, volatility is expected and silver's swings can be substantial. For those prepared to navigate the ups and downs, however, the rewards could be life-changing. The key is positioning yourself before the breakout, when sentiment is still cautious and prices remain below key levels. If you want to be part of this historic opportunity, now is the time to take action. Don't wait until silver smashes through the $50 mark and becomes a crowded trade. And as always, this video is not financial advice. It's an analysis of market conditions and opportunities based on Rick Rule's expertise and insights. Make sure to do your own research and consult with a financial advisor before making any investment decisions. So, will you seize the moment and position yourself for what could be one of the biggest silver rallies in history? Subscribe to our channel for more insights and to stay ahead of the market trends. Let's ride this wave together.
Deposits both have big risks, but small deposits can never make big money. And the focus on tier 1 is simultaneously reducing risk and increasing reward. Like all of my investment education products, anybody who signs up for the Rule Symposium who doesn't believe that they got their $99 worth just has to email me and I give them the $99 back. Full gold-plated money-back guarantee. I'm delighted to say in 28 years of money-back guarantees, I've had to refund less than 0.1% of the tuitions charged. But that notwithstanding, the risk is all mine. The only qualification I can give is that this is going to be very deep, very dense. If you're a tourist, if you're not interested in extractive industry, investment, and finance, please don't come. This is not going to be like reading the funnies. We're going to work you very, very, very hard. We're going to give you access to the recordings for a year, and you're going to have to play the recordings 2 or 3 times because we're going to give you more information than you can absorb in the time allocated. If you do care about extractive industries, not just gold, if you do care about extractive industries, I think this is an absolutely invaluable course. I have Steve Enders speaking, who was director of exploration for both Phelps Dodge, then the largest copper company in the world, and Newmont, the largest gold mining company in the world, talking about identifying Tier 1 deposits and the importance of Tier 1 deposits to multinational mining companies, which I think will be, a very, very useful discussion. I had a couple of investment bankers talking about identifying Tier 1 deposits and investing in the growth of Tier 1 deposits, and then the importance of Tier 1 deposits to multinational mining companies, which I think be a very useful discussion too. But again, this is an extremely dense topic. And people who are tourists, I hate to not sell my own product, but don't set yourself up for disappointment if what you're thinking is it's going to be a very breezy discussion about global macro.